What's up, guys? It's Andrew here from Pennant Players, and today we're going to be talking about swing trading. If you're looking for a video to teach you how to swing trade and basic technical analysis, this is the video for you. So without further ado, let's get into it. So swing trading is something that's very interesting to me because it tends to be one of the more simple techniques in technical analysis. There's many different pattern formations. And everything like that, and we'll be talking about those in videos to come. But swing trading is something that you can generally do passively. So what I like about swing trading is that you can do it over the course of a week or 2 weeks, or even a month or 2 months. It's something that you can buy shares in something, and then wait that period of time. With many other technical analysis techniques, you're going to have to constantly watch it on a much shorter time frame. But with swing trading, it's not necessarily like that. So you can, buy shares in something and then wait, So another thing about swing trading is that the core of it is you're really trying to find deals. It's essentially bargain hunting. So, when you go to like TJ Maxx or Ross or whatever you have near you, you're always trying to find like that bargain, and that's really what swing trading is. Swing trading, you're going to be looking at a couple indicators, which we're going to get into later in this video, and how to utilize those to find the best deals. You're essentially trying to find the shares of the company that you're looking at for the best possible deals. Okay, so what we're going to want to do here is the first indicator we're going to talk about is RSI. So what RSI is the relative strength index. So when you're looking at an equity, I think most of you are going to start out with something like stocks. What the RSI is analyzing is how overbought or how oversold the stock is in comparison to how it's previously been trading off the price action. And a lot of times you can see from these swing trading opportunities how the RSI is following the price action. You guys can see here with the ticker symbol XENE, which is something I'm currently watching on my swing trade watch list, is that when the RSI hits a point above this 70, it tends to be more in the overbought category. So right here, it hits this kind of period of over that 70, and you can see it follows it here where it's kind of a little bit overextended. So when you're looking at this, this isn't a good deal. This is something that's like buying at retail price. You know what I mean? It's not really it's not that discount bargain you're looking for. So you're gonna want to wait for something like this to get below that that 35-ish range. I set mine here at 30. So to get this on your TD Ameritrade Thinkorswim, you're just gonna want to go up here into this kind of like chemical bottle science looking thing. Should say edit studies. So you're gonna go into there, and then you're just gonna want to set this up like this. Click in here and type in RSI, then add selected and apply, and then OK. But how we're gonna use this is, again, we're gonna try and use this to find the best deals. So with something like this XENE, we can see it follows the price action pretty well. It tends to become overextended around this 1467 areas where it tops out, in terms of the 1475, around that area, in terms of the real body of the candlestick, which is not the wick. The wick is this portion right here that's the smaller portion, but you're going to tend to want to look at the real body of the candlestick, because that's a generally better indicator of the price action, because wicks can be somewhat erratic at times. But in terms of the RSI, you're just going to want to really look at how overextended it is, how overbought, how oversold it is, and then, compare that. So something like XENE, up here in this, 1475-ish range is where it tops at. And you can see the RSI is following that very well. The more overextended, the more, overbought it is, it tends to go down after. So you're going to want to look here. So this is kind of peaks out here. So this would be like buying at retail price. You're not going to want to do that. You're going to want to wait for a return to a much lower RSI. So why it's on my watch list now is because we can see here that the RSI dipped, below 30 at this one point right here. Got down to almost 23. And again, that followed the price action pretty well. You see we had the previous hits below 30 were in this range where, the price dipped down to, in terms of the real body of the candle, down to about $8. So, and then we can see a return up, an upward trend forming right here, right there. And we can see the RSI going with that. So right here it peaked out and it crossed above that, 70 category. And right then and there is where the price action topped out as well. So we're going to wait again, just like here, just like we would here in this category, this range. When was that? In December, when the RSI, dipped well below before a return up to, overbought. So right here, it, hit that 25, 26 on the RSI. So something like this, it's generally going to go back up. That's why it's on my watch list, because once it hit that, 25, 26 category on the RSI right along here, it's bound to go back up. But it might not. And this is something a lot of new traders really struggle with, is that just because something goes down does not mean it has to go up. A certain example of this would be here. So I remember this one because it's a very bad trade for me, but seeing this category here of the 3-year. So we'll take this. So what can we see here? Well, looking in terms of the price action up until through this point, what I was seeing was this swing trade opportunity, right along here. So what this is doing is, it's somewhat downward sloping. So that was my first mistake. If you're swing trading as a new trader, the trend is your friend. So you're typically going to want to find an upward trend within the price action for a swing trade opportunity before you enter. However, it's not necessary, but it certainly helps. So that was my first mistake. But second mistake was thinking that because something goes down, it must go up again. Now, this was one of these swing trades that did not fulfill that. So what we can see here is, a return from an oversold to an overbought range. So, that typical swing trade pattern we like to see. So I was thinking here, at this $8 category, it's bound to go back up, into somewhere in this range, this $13.38 to, $14.25, with the potential to go up to this range here, this $20.15 range. But, it doesn't always play out that way. So you're going to want to be careful with these, because as we can see if we zoom out here, what wound up happening with this is that it completely tanked. So just because, investing here, buying in here, um, or wherever, you're gonna think it's gonna go back up, but in reality, it will not always do that. You know, these patterns are gonna tend to repeat, but they won't always, and that's something we're really trying to hit on here at Pennant Players, is that to have caution in your trades. So back to this one, perfect example of a swing trade that I'm looking at. Um, that's a general overview of the RSI. So it's essentially telling you how good of a deal it is. However, it's not always the best indicator. So you're going to want to look at a few other things as well. Again, I said a general uptrend pattern. You're going to want to see, or at least a consistent, consolidation type pattern, which is trading in between, two parallel lines, channeling essentially. So we can see an example of that here with FIXX. So what was going on here was I was able to get in on this price action here because we can see that this is a gorgeous channeling pattern. We can see that FIXX here has, hit this above 70 category on the RSI and then dipped well below that to, below this 30 range, and then each time has hit and gone back up. So we can see here that this was something I was able to get in on because through this analysis, you can see that it's, ranging between these two, parallel lines, almost about parallel. Doesn't have to be exact, but and we can see here that this is the pattern forming. So I was able to get in here because you can see that it has this pattern here, in this left range, and I was able to draw these trend lines. So I was able to see both here and here that this was going to return to an about this range. See, now the thing about exit points, right, is the entry point. The entry point is going to be down here. But what about the exit point? Well, with the exit point, you're really going to want to try to get back up to this, parallel line, the top of that parallel line. But it doesn't always work out that way. And this is why you want to sell your position at increments. So you're going to want to sell incrementally. So you can use, something a little bit more complex, like Fibonacci retracements. But we'll get into that in a later video. For a new trader, you're just really going to want to, try and take it almost in fourths. So I'm typically more conservative with my approach. So, this was ranging, from here to here, which is, 100% profit. So that was well over, what I'm trying to accomplish. So, with this trade, I was really looking just for, a quick little, 10, 15%. So I sold some at the 5%, I sold some at the 10%, and I sold some at the 20% to get rid of my position. Again, it will be impossible to get a perfect trade. There is no such thing in trading as a perfect trade. You're not going to get in on this whole price action here. It's impossible. So you're going to want to get as much as you can without sacrificing any of your profit. So, secure the bag is what I like to say. You're going to want to buy in here at this point and then set a stop loss. So a stop loss is essentially if it hits, a certain point below where you bought it or what have you, then it's an automatic sell. So I put my stop losses right around here at, this 11, 75 range right in here. 1175, right about here, right there. Um, so if it went below that, I was gonna sell because you definitely want to gonna cut your losses at that point. Um, so you're not going to be able to get in on the whole price action. It's impossible. So what you're going to want to do is you're going to want to try and get as much as you can of it, the biggest chunk of it as possible, while also not sacrificing any profits. So that's where you're going to want to sell incrementally. Um, I personally like to get out as fast as possible with these swing trading positions because again, you don't know. Like going back to this one, SYBX, in this category, no one had any idea that this was going to happen. So it hit that, below 30 on that, or almost around 34 right here and here. So it was thought that it was going to go back up right here. And it did, but unfortunately, if you bought in here thinking it was going to go back up right at this 626 range, on 7/22/19, which is unfortunately when I did, you're going to want to have your stop losses, slightly below that. I personally take it at the lowest point of the support line. So in terms of this stock right here, it would be about this, 573 range. Because that was the lowest point it had gone before. So that definitely should have been an indicator when it hit that, 575, 58, that this wasn't something that's going to go back up. So that's why it's important to take your losses, cut your losses. So going back here, I think this is a very fine example of a swing trade, on the shorter time frame. And swing trades can be a whole bunch of different time frames as well. So you can have swing trades on the 4-hour, 180-day chart. You can have swing trades on the 20-day, 1-hour chart. You can have swing trades on the 3-year week chart. So it's really just personal preference. I tend to go with the 180-day, 4-hour chart because it's the time frame that I like. It's typically about a week to 2 weeks, depending on the equity you're trading, to get that price action increasing again. So another thing here, along with the RSI, is the MACD. So you're never going to want to rely on solely one indicator for the to try and find that reversal, try and find that bottoming out and then increase. And I think that's a mistake that a lot of new traders make as well, is relying solely on one indicator such as the RSI. You're going to want to find multiple indicators, and some of my favorites are Bollinger Bands, which are these 3 lines right here. Move my mouse over it, those 3, you can see them, but they're red, that highlighted category, that those 3, the red on the top, the blue in the middle, and then the purple on the lower side. So then you're going to also want to add MACD and volume. So I'm going to get into these now. So MACD is a really helpful indicator, and it's a little bit complicated to get into, but essentially what you're going to want to look for as a new trader with the MACD is to find this a crossover. You're going to essentially try and find a crossing of this blue over this yellow or beige or whatever you think this color is, but you're going to want to find a crossing over of that. But see, the issue here is you're going to want to kind of mangle all these different indicators. It's like you're cooking a stew, and you're going to want to get all the ingredients here, because if you're missing one, then it's not going to taste right. So you're going to want to get all of these different indicators and kind of fit them together into finding a good trade. So you, there's endless opportunities in the stock market. So you're not going to want to take a position if you're not fully confident in that position. So always wait. You're not just going to want to take these positions if you're not fully confident. Like, say it's based off of one indicator. Say it's based off the RSI. The RSI is looking good. It's looking to be turning up, coming off this 30 range, and it follows the price action really well. But the MACD isn't looking good. You're not going to want to take a position like that because again, it's like a stew. One ingredient can throw off the whole recipe. It's like anything. In cooking, think about it. You're baking a cake or whatever. Just that one ingredient can throw off the whole taste, the whole appeal of it. So you're gonna want to mesh all these indicators together to really find that perfect trade. And there's no such thing as a perfect trade, of course, but you're gonna want to get as close to it as possible, as confident as you can be in your position before you take a position. So now back to the MACD, you're gonna want to look for a crossover of the this blue line over this beige line. What this is indicating is a reversal of the general trend. So you can see it's trending downward here, right in this category. Boom. And then we can see from here that a crossover of the MACD from the blue line hitting over that beige line, and then it explodes with this big upward movement here. So that crossover was the point at which the reversal happened. So it would have been great to get, again, there's no such thing as a perfect trade, but it would have been great to get in here, and then boom, crosses over and a huge upward movement. With the MACD, it's a formula basically, and indicators are they're not some special tool, they're not some special, magic potion. They're just another way of displaying the price action. There's an equation for all of these indicators, and it's just another way of displaying the data that you have in this chart here. It's not some thing that someone came up with. It's like this special potion. It's just another way of displaying the price action that you can already see here. So it's not it's a tool to use to predict future price action, but that's not the purpose of it. The purpose of it is to show how it's acting right now. It's not to, predict. You can use these indicators to predict, but that is not the purpose of them, if that makes sense. It's simply to show the price action in another form, an easier way to see things, another way to see things that's different than what you may have thought. So back to the MACD, we can see this crossover starting to form here, which is why this is on my watch list. And you can use these, it's kind of histogram type thing. You can use this as well. I generally find it to not be as useful, but it's still useful at times. If we see, this kind of like hump forming, right? You can generally say that there's going to be a reversal, but it doesn't mean that there will be. So, you can see this coming down right here. Peaks out right here, then it starts coming down. You can be like, oh, whoa, let's take a look at this. So maybe add that to your watch list if everything else is looking good. But that does not necessarily mean that there's going to be a reversal, because as we can see here, it went up, the hump started going down, and then it just goes back up again, right in this range here. It started, it started going down, and then spiked back up, and then started going down again, and then just spiked back up. So that's not really a great way to do it, but it's certainly a predictor. It's another part of the puzzle. You're going to want to try and find, all the pieces to this puzzle for swing trading. So another thing here is that, you can try and predict this crossover, but a much safer entry point would be when it actually crosses over. And because as we can see here, if you're trying to predict that crossover, then you might get caught. So, for example, right here you can see this is at every point here. It's kind of looking like it wants to, like it's looking like it might turn up, in this range. You can see that it starts, turning back. So it crosses over here at this point, and then once it goes down, 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 you can see at this point, along here, that it's looking to turn up, and then it happens again over here. You can see that, general kind of upward curvature of the blue line looking like it's going to cross over the beige line. However, it doesn't. And, the price action continues to fall. So that would be like a minus. If you tried to go there at this point, you'd lose like 30%. It's, an unbearable loss right there. So you're going to want to look for an actual crossover. Now, you might be missing out on some of the price action, but it's a much safer way of trading. We can see here that, it crosses over, so you're going to miss out, You are going to miss out on some of the price action, but again, this isn't what we're trying to find. We're not playing this move right here. We're not playing this reversal right here. We're trying to play is the upward move, so we're trying to play this whole thing here. You see what I mean? This, big gain right here. So if it's okay if you're sacrificing this little part here, if then that makes you more sure that it's going to continue to do that. Do you see what I mean? So you're really going to want to try and find an actual crossover, not just like it's looking to turn up. Another type of indicator we're looking for is the volume. Now, the volume is essentially just how many people are trading it, how many shares are being sold, how many shares are being bought. So you're going to want to look, if you're trying to find an upward movement, based off of these, swing type trades, you're going to want to look for a movement with an increase in volume. See, if it's a movement, an upward movement, typically is much stronger propensity to continue going up if the initial movement had more volume. And what I mean by that is the volume is essentially laying the foundation for the move. It'd be like trying to build a house, right, without that base. Build all these skyscrapers. They all have, these large fundamental backings, all these large cement structures behind them, beneath them, in order to lay up the whole structure. So it's the same thing here with volume. If you see an upward movement with low volume, that's typically not as strong of a move as an upward movement with increasing volume. Bearish or bullish increasing volume. So you're going to want to look for bullish increasing volume, a move up with strong volume, because that continues, it increases, the propensity to continue going up. So what we're going to want to see here is an increase in volume, and we can see that here, so these stronger moves like here, boom, look at how large this increase in volume is. We can see it going from practically nothing, at this, the volume is extremely, extremely low here. And, this is all just kind of coming together right now. So we can see at this point here, the volume is very low. The RSI is, getting lower. It's in that 40 range. So, and, the MACD, just crosses over here. And then it goes back down again, but then the big crossover happens here. And we could see that the volume at this point is increasing. So we could see a sharp move up with this initial bar right here. This is the first bar that's really, a big step up from the last price action, and almost 10% profit or 10% gain in a day. So, and we can see the volume there is very good. So that's indicating that there's a strong fundamental backing to the move up. So this is a position you would like to take. Whereas, something with, lower, a move up with lower volume isn't going to be as strong. So something like this, for instance, right in here, you can see that this is a move up, but what this is a dead cat bounce. It's in a general downtrend here, but it still gets, a nice little bounce uh, before a larger move down. So optimists, are buying in here, thinking it's going to continue this uptrend here, but it doesn't. So, and, one of the ways to tell that, hindsight's always 2020. It's a different thing in practice, but we can see here from XENE that on this move up, was 15%. So this is a much larger move up than this, little 10% on this one bar here. However, the volume on this, we can see it here. It's like nothing. It's not anywhere near the volume that any of these movements had. It's practically nothing. It's down here. It's not increasing from this point. So from this point it was here, and this point it was here. So it's not something we like to see. So I wouldn't have taken this position. Again, you're gonna want to try and find a stew of all these indicators to get the best flavor. You know what I mean? So this volume here, again here, this is a large volume jump. It's boom, increasing right here. This move up, this increasing volume from there to there signals a strong bullish move. And then it continues to go up. We get either more sparks in volume. So something like this, we can see, it had a large volume going down, which isn't something we like to see. However, with all the other indicators combined with this, I'm thinking this is going to prove to be a profitable swing trade because, again, once it came down here, at this point, the volume started to go back up. So we can see this, rising step pattern right here. So boom, and now it's going up from that, bottom right here. But that's the general basis of volume. You're gonna want to try and find, what it's doing comparative to the price action. It's signaling how strong the move is, how many people are trading it, and again, volume can come in many different forms because it's people buying and selling it. So strong volume on a downward move, it just means that a lot of people are selling it. So it's not always volume. High volume is not necessarily a bullish indicator, but it certainly can be used to determine a bullish move, if that makes sense. So we have volume, RSI, and MACD now. The last remaining thing is the Bollinger Bands. Now, the Bollinger Bands, it's something you can use as a new trader, but it's typically a little bit more complicated than that. You can utilize it, but I wouldn't solely rely on it, and here's why. What Bollinger Bands do is essentially saying the price has been, between this range and this range, and it can't go above this range and it can't go below that range. And that range, the lower range is this purple, and the upper range is this red. But what Bollinger Bands don't do is account for breakouts. So in a period of consolidation or just a general uptrend, channeling, anything like that, Bollinger Bands are very useful. So we could see here, after this move up, it started this, consolidation type, kind of like parallel line type beat right here. Right here. So, it's generally moving in between, these two lines. And we could see that from the Bollinger Bands. So once it hits, the top of the Bollinger Band, it goes back down. So you can try and trade off the Bollinger Bands because they're predicting, how low and how high. So entry and exit points is essentially what they're predicting. But it doesn't account for breakouts. A breakout is when, right here. So after this period of consolidation, um, it broke out. And we could see the same thing on a downward move as well. If this were to break out down this way, you'd be extremely caught off guard. You'd be like, whoa, but the Bollinger Bands showed it can't go below that range. Well, it certainly can. As we can see here, it crossed that Bollinger Band and just started, breaking out to the upside. And it can just as easily happen on the downside. So while Bollinger Bands can be useful, they can sometimes almost be a trap for new traders because, again, they don't really account for breakouts. So yeah, that's it, guys. It's just a general overview video on how to swing trade, what swing trading is. Be sure to subscribe, share, like, and comment what you'd like to see in future videos as well. Thanks for watching. It's Andrew from Pennant Players, and I'll see you next time. Stay green.